Thank you so much for joining us today. Vijay, thanks so much for being with us.
Nice to be here.
So I was actually doing a little bit of research this weekend, and I saw some extraordinary stats. The latest report out from U.S. SIF, which tracks sustainable investments by U.S.-based asset managers, they do it every couple of years, and the latest stat is that assets in sustainable investments have jumped 38% to a whopping 12 trillion. That's with a T. But as was noted by my colleague, TIAA has actually been one of the longest standing managers in socially responsible investing for decades in both stocks and bonds. So Vijay, can you take a step back and talk to us about what's changed at TIAA and its investment arm, Nuveen, which you head, in terms of how you invest sustainably for clients?
So firstly, it's great to be here, and I feel a little bit like I'm re-interviewing for my job because I see many directors from TIAA here in the audience. But and it's that time of the year end, so I better do a good job. You know, it's really been a journey. TIAA got involved in responsible investing for about 50 years ago. It started off in South Africa at the time of the apartheid, and ever since we've made progress in a variety of things, whether it's in farmland, conservation, financial inclusion, affordable housing. So it's really been a journey, and I can't point one particular year or a particular time when we flipped the switch. It was really appreciating that you can make a positive contribution to society and at the same time make a good return for your clients.
Well, what about investor demand? How much of that has been driven by your own clients saying we want these approaches applied to farmland investing, or as you said, affordable housing or real estate?
Yeah, you know, today there's not a single RFP that we get from our institutional clients that does not talk about what are we doing on sustainability, impact, or responsible investing, or ESG. And I think if my memory serves me right, over 40% of RFPs have a question on responsible investing. And gone are the days where you could just put a blip, you know, few lines in and say, yes, we've kind of checked the box. At the time of due diligence, and many of you are clients here in the room, they actually come in and talk to our portfolio managers to demonstrate what are the examples of some of the things we've done.
Well, that leads us to the point about, and apologies, Sir Ronald Cohen was supposed to be with us today, and he unexpectedly wasn't able to travel at the last minute from Europe, but he has influenced a lot of things we're going to talk about today in terms of our prep call. And one of the things he talked about was one of the big challenges in the field right now is, can you measure impact?
Right.
So what do you think? What are your thoughts on that?
So that indeed is a challenge. I think if you look at ESG, I mean, that's fairly well understood. Whether you are demonstrating a return based on ESG principles in Australia or Europe or Latin America or the US, it's fairly well understood. I think on impact, it's yet a little bit vague. And so how do you measure that impact, and especially with 2020 hindsight? I think that's the concern a lot of portfolio managers have, that it shouldn't be a gotcha. And so we are all working with Morningstar, with the consultants. How do you actually measure some of this stuff? But I can say that on the bond side, for example, there's been tremendous progress. I mean, over the last 6 years alone, green bonds have increased you know, from $10 billion to $500 billion today. And Nuveen is, in fact, the largest owners of green bonds, US-denominated green bonds. So we are seeing on the bond side, but there are concerns about greenwashing. You know, how do you measure some of this? Are people using terminology loosely? So those are things that we're working with our portfolio managers and as well as with outside academics.
When you talk about the challenge of managers being concerned about investors, if I'm understanding you correctly, having 2020 hindsight, can you expand on that a little bit more? What do you mean in terms of that being a challenge?
So when it comes to measuring financial return or any of the ESG principles, whether it's governance, so the approach we've taken is that, listen, we may influence some of the measurement by engaging with academics, other institutions, but we need to do what's right for us. And so what we've done is we've done three things. One is integrate responsible investing in the daily investment analysis. Today, out of $1 trillion, $600 billion uses some form of the UNPRI principles. That's 60% of our entire universe, whether it's in private equity, bonds, or listed equities. So one is the integration. And today I can safely say all our portfolio managers are keenly integrating in their investment process. It's not just a screen. It is, they kind of start with that. The second is engagement, because I think rather than just vote with your proxy and exit a stock, we are heavily engaged with management. Last year alone, we had 300 meetings with senior executives, CEOs, and CFOs of the companies in which we've invested in. So we are engaging with them what they believe is governance, responsible investing, environment, impact, et cetera. And then the last part of that journey is really impact. I think impact is yet a few years, I mean, we are in that process, but the first two are fairly well understood. Impact is yet at its infancy stage, but we are very active on the private equity side. We are doing a lot on the real estate, with our real estate team, as well as our farmland.
What makes it so hard to measure the impact? You were saying we're in the infancy stage of that. What's so challenging about it?
I think it's the portability of the returns. I mean, the portability of that number. But I can tell you the good news is McKinsey just did a survey in India that on impact investing, the median return was north of 10%. And if you take the top 1/3, that was 34%. So you can see that you can one is you can measure it, and secondly, there is genuinely a positive return to be made while you're making an impact to society and to the people.
So let's touch on that a little bit more. One of the big things I always hear when we're talking about investing in socially responsible funds is we're always talking about, well, what's the return? Are they giving anything up by screening out certain stocks or by making different calls on investments? What's your take on that?
I can categorically say that answer is no. There may be certain cases, it's 2 steps forward, 1 step back. But I'll give you an example, two examples actually. One is in our real estate team. We have committed to, by 2030, we will reduce our use of energy in all our buildings, in our real estate investments, to meet or surpass the Paris agreements. So we are actually seeing, by doing that, we are actually getting a better return on our investments. The prices of those properties, whether we are selling them or renting those apartments out or office space out, you're getting a better return. So it's not about just doing good for the sake of doing good. The second is in Napa, a good factoid to know, Nuveen owns 20% of all Napa wine production. That's a pretty good factoid to have. But,
you should have brought some with you.
But maybe we can have some at dinner tonight. But I think the more important one is that when we made our first investment, we engaged with the local wine growers. And with just a $2 million investment, we engaged with a variety of wine growers in the area, and we reduced water conservation, or increased water conservation by 75%. So you can actually see those returns do filter into profitability, and therefore it's not only about just leaving an impact, but I think you can actually make a return.
And just so I'm understanding you correctly, are these on investments you've had existing in the portfolio? For example, in the real estate portfolio for your 2030 target, are you retrofitting some of the buildings, or is it only in the new properties that you buy?
It's a bit of both, and I think definitely on all the investments going forward, we are known for our green standards. We are seeing a very positive return. We just launched a Asia Cities Fund, and even though maybe Asia is not as far advanced as Europe is and Australia, but we are seeing there the demand is, when we talk about our green approach, you actually see a higher yield in our real estate property.
So you mentioned Asia. What are you seeing globally in terms of the differences in where we stand on sustainable investing?
I think especially this audience knows that Europe is definitely ahead of the curve. as is Australia. I think both these, Europe as a continent and then Australia, both are, started down this path, many years ago. The U.S. is catching up, especially the DB plans in the U.S., the endowments, and then don't forget the millennials. Today there are 50% of high net worth individuals who demand some form of responsible investing.
50%.
50 of the high net worth individuals in the U.S. Now that number, and I know this is an overused term, millennials, but 90% of millennials that are in the high net worth category, and there are many, as you know, through IPOs, et cetera, or even inheritance, 90% require some form of responsible investing. And over the next several decades, $30 trillion will transition to the millennials. So you can only imagine, not only are they investing with some kind of conscience, but they will also be more vocal with their own firms for their 401k plans or any consumption that they make, whether it is commodity goods or anything that they buy. They will be asking those same questions. So I'm actually very optimistic, notwithstanding the challenges of measuring and 2 steps forward, 1 step back. But I think directionally we are on to something new.
But what about things, I was thinking this weekend when I was reading a lot of the coverage about the riots in Paris over the so-called green taxes, the taxes they're putting on fuel consumption there, in part as a way to combat climate change. What do you think, what impact does that have in terms of the political landscape changing around the world?
This is just practicality. At the end of the day, people need jobs, people want, so that is going to happen from time to time. But I look back at Toyota and the Prius, right? Many years ago, because of fuel prices being up, and a lot of demonstrations on fuel prices, Toyota decided to move towards the Prius. And it was a lot of people said, this is not sustainable, the hybrid car, but today that's mainstream. And today it's not just Toyota, but it's all cars that really have hybrids. So I view this impact, responsible investing, ESG, a little bit like that. You're going to hear news bits and incidents from time to time that question some of this. So you may have to take half a step back or a step back. But directionally, I think the industry, as an asset management industry, we are moving in that direction where this will become kind of mainstream. Frankly, if I can just say one thing, I remember saying this at another interview, that I personally believe even ESG will no longer be a category because it will get integrated in the way analysts analyze the stock. Because how can you buy a stock without having a view on the governance of that company? So why is that even a category, right? You have to ask about governance. You just have to see what happened with Volkswagen or GE and realize that governance is important, right? Same thing with environment. If you are if you're you're consuming power, how can you not ask the question, what is the impact? So it's not, on the environment. So I think over time this becomes far more mainstream, and which is a good thing. I don't mean to say that that'll disappear as a bad thing, but I think it'll just become part and parcel of regular analysis.
How are you retraining, though, some of the people that you have on your staff in order to integrate these type of thoughts into their process?
We have a lady at the back, I just saw her right there, Amy O'Brien. She's the one who is championing this cause within TIAA Nuveen. And I can tell you, if 5, 7, 8, 10 years ago, it was probably a challenge. It was a one-way thing that this is the right thing, this is what we should do. Today, there's not a portfolio manager who's not reaching out to her saying, how can we better integrate our process? And that's why, in a fairly short order, 60% of our $1 trillion, we have integrated responsible investing in their process. So it's no longer an afterthought, it's no longer a screen, it's very much integrated in their DNA.
So before we open it up to questions, one of my last questions for you directly would be, what do you think is one of the biggest challenges to the industry moving forward?
I think it's not to get disheartened when you're called out, and you will be called out from time to time. We can say we've reduced water conservation by 75% in Napa, and one particular year there may be some statistic that shows that that number was only 60%, or there's a further drought and we're not kept up. So you're going to get called out, and sometimes it's, as I said, it's with 20/20 hindsight. But I think as long as you can put your hand on your heart and know that you are doing the right thing and you're making that progress, you're going to get some negative headlines. That's number one. And number two, we all need to work with academia to develop better metric. Now we have the UN, PRIs, but again, you need more quantitative measures, especially on impact. And it's a little bit like I always joke about my weight. I need to measure my weight every morning to know whether I'm making progress. In my case, I'm not, but I think that's really
that's bold that you do it every day.
That you really need to do that. And I think with ESG, we've made a lot of progress, and today that's fairly well understood and easily measured across continents. On the impact side, we've yet got some more work to do.
Well, let me pause there. Are there any questions from the audience? Yes, actually,
Thanks,
go
Peggy.
ahead.
Hi, everyone. My name is Lauren Keel. I direct the Bloomberg Sustainable Business Summits. I'm going to be here for the next 2 days to take your questions for our speakers. So please go into the app that we talked about earlier, and you'll be able to submit your questions there. As a reminder, it's grif2018.app. While you guys are submitting your first questions, if there's a seat that's open next to you, could you just raise your hand for some of our folks in the back? So anyone who's in the back can come on up. There's a bunch of seats. Come grab a seat. Come grab a seat. Keep those hands up.
We do appreciate the standing room only, though.
Yes,
it's
glad
packed.
to see a full room. All right, while we do that, let's take our first question. How are you matching the timing between responsible investments and the returns on those investments?
So I don't think it's a blanket question. I mean, it depends on the particular asset class. So on impact, as I said, it's more on the private equity side. But when you look at responsible investing, I think our statistics show that our funds are doing extremely well. We're fully integrated. We have 13 affiliates across Nuveen, and most of them are integrated with the responsible investing criteria. So I think performance and responsible investing are going hand in hand.
Vijay, responsible investing has so many definitions in the sustainability space. How do you and Nuveen define it?
Yeah, so I think that is a good question, because it is really a evolution or a metamorphosis. It starts with just, well, I shouldn't say just, but the easiest really is talking about ESG, right? It's well defined, people understand it. As you move up the curve, once you just look at the ESG and you just, basically are voting your proxy, whether you like the governance or not, I think the next phase that the industry is evolving to, and I know I'm very proud that Nuveen is fully there, is on engagement. Engagement with management, because it's not about just saying, whether it's a positive or a negative. It's how do you engage with them? What are their long-term plans on governance, on environment? And then the third phase is on impact. And I think that's where it's yet early days. A lot of firms are doing it. A lot of investors are demanding it, but it's yet not there as the first two. So that's the journey. How do you reach to impact finally?
Is there a focus on responsible investing something that must come from the top, and how do you get your employees on board?
Frankly, I feel it's really the clients. At the end of the day, we are seeing that clients, it's a little bit of what the asset manager wants to do, but frankly, the endowments, the pension funds are the ones that are demanding it. And those who are agnostic, who are blinded, who are not fully appreciative of how much that demand has changed, will be left behind. So I think that's really the driving force, is from the clients.
The corporate green bond market in the U.S. is lacking behind Asia and Europe. What's needed to catch up?
I think it's just time. I mentioned, Nuveen is one of the largest U.S. denominated green bond owners. We are the third largest in multi-currency. But I think as municipalities, especially in the muni space, the infrastructure space, you're going to see more and more of these green bonds get offered, and it's a little bit of a what goes first. So we've launched dedicated green bond funds, and we may be a little bit ahead of the market, but we feel that unless you have the capital available to actually make the investment, so you're seeing both sides. You're seeing a greater issuance, but at the same time, more investors kind of investing there. That number has increased from 10 billion 6 years ago to $500 billion. So you're seeing that progress.
Is your goal that eventually you'll be at 100% assets under management that are responsibly invested, or do you think some investments don't lend themselves to responsible investing?
I mean, I think I won't kind of focus on one particular percentage, but yes, directionally we are in that, and as a firm, we are pretty much moving down that path. I would say that we may not have 100% on impact, that's for sure, but on responsible investing, I think there's a big difference, and people tend to confuse the two. I think on responsible investing, that's the objective, is to move towards 100%.
At Nuveen, which asset classes have had ESG and responsible investing progress the most, and which have the most work to do?
So within the private equity group, where we've made investments on financial inclusion, on other sustainability, on affordable housing, we made a fair amount of progress there. On ESG, our ETFs that we've launched have an ESG overlay. So we are not just in the regular ETF business, we have an ESG overlay. And then on the regular stocks and bonds, as I mentioned earlier, there we have kind of integrated in the investment process responsible investing, and that's kind of moving every year, progressively towards 100%.
What do you say to organizations or people who do not embrace ESG investing, climate change or SDGs? How do you change their minds? What do you think is the most convincing of the arguments?
I don't think we need to change their mind. They'll be out of business. Because, no, seriously, you're seeing the demand coming from investors. It started in Europe and Australia. That is definitely moving towards the US. I talked about the millennials, endowments, pension plans, etc. So if you don't start integrating that, and I think in the old days you could put in a paragraph or two just to kind of check the box. Now with the due diligence process, people really want to know not only what are you doing, but show me your track record. So I think every single firm, they may be at different stages of evolution, but any firm that wants to be around for the next 10, 20, 30 years will have to integrate that.
But what's the risk, Vijay, of all of a sudden a ton of people coming out with products that are marketed as ESG or sustainable investments, but they don't actually have the goods?
So you get the good with the bad. So that's called greenwashing. I mean, there are a lot of firms, a lot of funds, a lot of investments that want to get the terminology, that we're a green fund or green bond. So, it's like anything else. You're going to get there are going to be some bad apples, from time to time, but it should not dishearten the rest of the industry. You're going to get some negative press. You're going to get that. That's for sure. But I think directionally, we are seeing more and more. I mean, just look at this audience here today. I mean, if we had done this 7, 8, 9 years ago,
would have been just you and me.
It'd be you and me. So I think that itself is a testament to how we're making progress.
I think we have time for one more. For a firm thinking about issuing its first best-in-class ESG fund, maybe nervous about what that uptake will be, what advice do you have?
I'd say stay the course. I mean, it's no different than the first fund that was launched on emerging markets, or I was just reading the Wall Street Journal over the weekend, the first S&P index fund that Vanguard offered raised, I think, about $8 or $10 million. So, is now we're talking in the billions and billions. So I think it's just some of us are a little ahead of the curve, but directionally I think we'll so my advice would be just stay the course.
Wonderful. Thank you all so much, and a big thanks to Vijay for being with us today.
Thank you.